Good morning, everyone. We'd like to welcome Jay McBain to our podcast program today. Jay is one of the preeminent research analysts in the computer industry. He has a worldwide reputation, and it's exciting to have you with us this morning, Jay.
Well, thank you so much for having me.
I think we've probably known each other at least 5 years. We may have met here, there, somewhere, like a BAPTI conference or some type of event. And I know you and I talked prior to me having my company acquired by 360 Insights. We were delighted that you were able to feature MTC Performance at that time as part of your channel incentive infrastructure matrix. So that was kind of nice. We had a chance to show you our platform. And so I think that's one of the ways we got acquainted. Now, you're with Forrester, and would you like to add a little bit about Forrester's focus and direction at this point in time?
Yeah, absolutely. Forrester is obviously a very big company on the analyst side, research side. Other companies in this space like Gartner and IDC, we wake up every morning and get very excited about certain intersections in the market. Some analysts get excited about a certain buyer, like a marketing buyer. Some get excited about an industry like finance or fintech. Some people get excited about geography, what's happening in Scotland. Some people, in sector segment and size like SMB versus mid-market. Others get excited about products. It's not hardware, software, and services anymore. We have 26 categories of tech products and 250 categories below that. So I may get excited about a certain 7 layers of security and the 17 layers below that. So we have analysts, like thousands of them every morning, that get up really excited about very certain things. And I get excited about the 75% of world trade that goes indirectly. All of the partnerships, how to manage that, how to incent that, how to recruit that, all the different elements of the programs, the processes, the people, and then the underlying technology that makes it all work. And about 75% of world trade goes that way. And 64% of the tech industry goes that way. So it's a big conversation, and it keeps me busy.
And it would appear to get more interesting by the day, wouldn't it? So one of the reasons that I teed up this conversation today is because you published an introduction to some research that you've done very recently with the title of Are Distributors the Future of Distribution, which is an intriguing title all by itself. And I'd like to discuss many of the points that you make here in this article. You walk us into the discussion with the M&A activity that's been going on with the megalithic distributors that we're all aware of. It seems as though in the last year, Ingram Micro has been acquired, Tech Data was acquired, and Tech Data and Synnex have subsequently merged. And there's all sorts of shifts that are occurring as a result of that. One of the things I thought that was really interesting, not only are these major moves in the marketplace, but what's been happening is the valuation of these organizations seems like it's really taken a nosedive at the same time as, generally speaking, emerging technology companies' valuations are skyrocketing. So we have a highly divergent situation going on there. And I'd love to hear your thoughts about why that's happening whatever you can add in the way of color commentary there.
Yeah, so the first thing to think about in distribution is it is different around the world. In North America, we have Fortune-sized distributors, Fortune 500-sized distributors. Ingram is a $50 billion company. The second and third biggest distributors on the planet, Tech Data and Synnex, just came together a couple of weeks ago to become TD Synnex. And they're now the largest in the world. They're about a $60 billion distributor. So these are massive, massive companies. They might be the only Fortune 500 companies, by the way, that my kids who happen to be in law school, the older ones, wouldn't recognize the logo of. They're the size of, these big companies like McDonald's and Nike and stuff, but, they've been hidden to the consumer for almost 40 years. If you go over to Europe, there's 75 countries in EMEA, and you look at that, there's 150 value-added distributors that carve up that space by language, by geography, by currency, by tax, all the different levels. It's a much different market than having these Goliath-sized distributors. And then when you move over into Asia Pac, talking about China, and I worked for Lenovo for a number of years, a Chinese-based company, looking at the distribution in China versus Japan is just oil and water, completely different. When you move down into Australia, you move over into Singapore, you move into all the Southeast Asia country. It's just a completely different distribution model. So when we're talking about distribution, you've got to kind of line it up geographically first. But second is you look at the valuation, like you said. These companies, most of them were taken private. They were public companies. And when Ingram was taken private, and they changed hands a few times, it was almost to 10 cents to the dollar. Where a $50 billion company was first taken private around 5 or 6 billion, it became 7. But the fact of the matter is that's close to 10 cents to the dollar. When you look at this big $60 billion company that was created, TD SYNNEX, it was created for about $7 billion. So again, it's on the other side of what we normally see in acquisitions in the tech space. The big SaaS companies today, and when Slack gets acquired by Salesforce, and we get to see these things in the news, these are at 10-time multiples, if not more. So we're talking 10x versus 10 cents. And it's just orders of magnitude difference of moving products through a supply chain, through logistics, through credit and capital facilities, and then out, distributing atoms and bits is just a different business model valued by investors differently.
Well, even given that, I would say probably 10 years ago, it wouldn't have been that extreme. So there's probably some serious deflation going on in the valuation. And what's the underlying cause of that?
Well, that's the report that we're talking about today. Is there's a number of headwinds. And people joke around, and if you talk to the GTDC, the Global Distribution Council Association of Distributors, for 40 years, people have been talking about the end of distribution. And I want to set it clear that no one is talking legitimately about the end of distribution. It plays an incredibly important role. And what we're talking about here, though, is almost everything we research at Forrester, the future buyer, the future way money's going to change hands, this future of work, this future of B2B and B2B to C, and all these different elements, these galactic research projects, all come back to be headwinds on distribution. So it's not an end of life conversation. It's a big reorganization or transformation of the value they bring to market, and the recommendations that we'll get to at the end are different than what we would have heard of in the last 40 years of talking about distribution. It's not direct versus indirect. It's not, what we would have heard in the past. There's some larger things at play here. And I list, 10 of them that are all true. There's not a valid argument against these 10 trends. Most people would agree with them. And when you add them all up together, you start then having the conversation. Are distributors really the future of distribution? And it created controversy because it's a clickbait title. Got me a couple of cease and desist letters from some, but it had to be said. The magazines have not had this level of journalism to ask this question. The industry, though, is buzzing. We get to talk to 10,000 channel chiefs at Forrester, and it's buzzing. These conversations are being had, and these are legitimate questions of where the value is and how to take it forward.
And I guess the other thing that we'll get into in a lot more detail as we go is, at one point we would have said that the businesses are being bifurcated into the traditional hardware software business, but also they're moving into the cloud business. But it's more complex than even the cloud business. It's including any number of new business models and new delivery systems that they're trying to put systems in place to support. And they're so different from the historical model that they're actually either splitting the companies or running dedicated resources for those other models. They're functioning completely separately.
Yeah, let me give you some numbers. In emerging tech, IoT, AI, automation, 5G, blockchain, quantum computing, VR, AR, MR, 3D printing, whatever it is, these models, there's 800,000 companies today that we're watching. And in a lot of cases, that's hardware. They're moving products across oceans, and this product needs to be distributed. On the SaaS side of things, 10 years ago, we had 10,000 software companies. Today, we have 175,000. And I predicted 10 years from now, we have 1 million SaaS companies. So just there, when you said hardware, software, and now services, but when you start to break it up, we don't look at that anymore. We look at 26 categories with 250 categories below it. So you can't have a security software conversation today without breaking it up into the 7 layers of security and then 17 layers below that. So it is highly complex. Once you start multiplying 800,000 companies by 1 million, by 35 million customer conversations happening in the tech industry today, by then millions of partners that you see over my shoulder in a Venn diagram, at some point your calculator is going to kick out an error, because the permutations and combinations that we're talking about here are so far beyond. When I was at Lenovo or IBM, I had 12,000 SKUs that I had to distribute. And then I had to distribute that to 75,000 bars, for example, in a certain region like the US. That was somewhat linear supply chain stuff. When you have to go into the trillions or more of permutations, now we're talking AI and automation. There's no linear human-based automation model that moves that level of orchestration. And that's one of the headwinds facing distribution, is that all of this different parts of what used to be a linear supply chain have blown up to be celestial, with trillions of moving planets and star systems and comets and moons and rotating around all these different galaxies and suns and things like that. And trying to orchestrate this massively decentralized market when you're not the tip of the spear is incredibly difficult.
Yeah, so we're actually jumping to the last point in your paper, which is great. And that point was no one can hide in the nonlinear ecosystem. And I had my own note on that, because all of the conversation has been cloud everything for almost 10 years now. But what you've just told us, which makes all the sense in the world, is it's a completely nonlinear system, or it's moving toward a completely nonlinear system, which starts to look like the channel starts to look like a neural net of intersecting value propositions, all of which at some level are required to function together to deliver the complete solution. So, that's a huge shift in terms of the way distributors or software publishers and manufacturers have to look at the marketplace. Completely different. And I would assume there's really significant impacts in both. Again, I use the term manufacturer for software publishers as well. But whether you're a manufacturer, a software publisher, or a distributor, you've got to really radically change your existing go-to-market model in order to deal with that.
It is. And we know that 76% of CEOs today, in every business, in every industry, regardless of which way you're looking at it, think their current business model will be unrecognizable in 5 years. That's an Accenture piece of research. 76%. So we're seeing, in our world, radically shifting business models. You'll be asleep at the switch if you haven't seen Cisco and Dell and HPE and IBM and all the big companies from the client server era have gone all in subscription consumption. HPE is going to be there in a few months, where you can't buy $1 million server anymore. It's $9,000 a month forever. Last week, Lenovo went all in. Nutanix. All the way down the list. This era, which was the distribution era, all that product had to move through, and the capital and credit and floor financing and all the things that needed to work with inventory, that's fading away given where these models are going. So this is just a radical shift that's happening everywhere. But the core threat here is, in that model of distribution where everything has to move through a linear phase. And that's the key. And you've got, new buyers. And the answer to all that complexity, by the way, if you want to simplify it all, is back to the buyer. So I mentioned there's 35 million kinds of tech buyers. It's broken down by the lines of business who make 65% of cloud, SaaS decisions today. 2/3 happen outside of IT. The head of marketing in many companies spends more money on technology than the head of technology. Second, we talked about sub-industries. No one's a healthcare expert anymore. You're an expert at a 50-doctor clinic. You're an expert at a dentist office. You're an expert at a small hospital. There's 12 sub-industries behind the 27 major industries. There's 297 sub-industries of expertise in the channel. There's the geographic differences that we talked about before, 197 different countries. You've got the different segment and sector. If you're an SMB player, SMB has 6 categories inside of it. You can't compare a 9-person company with a 49 with a 499. There's no comparison. And there's different channels that wrap around all 3. And then finally, 250 layers of a tech stack. I can't even find a security company that can handle all 7 layers of security, from physical to network to web to data to endpoint. I can't find malware to ransomware to email. I can't find a company that has the broad skills to do that. So everything sits in a stack. So if you think of those 35 million conversations, a mid-sized clinic in upstate New York, a marketing buyer, those millions of permutations quickly come down to 50 companies in Buffalo, Rochester, Syracuse, and Albany that wrap around or potentially wrap around those 28 digital moments that marketing buyer walks through before making a decision.
It's interesting. It's interesting that you bring that up. And again, I wasn't going to talk about this, but you're really triggering a personal experience. When we were operating our company at MTC, we wanted to get IT outsourced support. So, we were basically running a 1 or a 2-person shop in a 25 to 30-person company. And those 2 people were running the full realm of IT services, from the most sophisticated to the most minimal. So we thought we'd supplement that with a managed service channel partner that was capable of augmenting everything we were doing. We couldn't find it. I mean, we continuously kept walking into organizations. They were all Windows centric. They didn't understand Linux. They didn't understand security. The sophistication of the people that they had was much more oriented towards desktop support than it was towards sophisticated IT systems. And so I think that echoes exactly what you're talking about, the tech stack. And that's a simple example, but the tech stack it flies off in a million directions. And assembling a coherent delivery system for all of that's got to be quite a challenge.
Yeah, so the multi-cloud and hybrid cloud era, post-client server, created the end of the single throat to choke, the end of the single trusted advisor. You just don't hear that if you go to events anymore. Why? Because in those first 28 moments at the point of transaction, and then every 30 days forever, you've got on average 5 different partners at the table. And we now know the quantification of what they're doing. If it's a HubSpot deal, there's $5.80 over there that those partners are handling. If it's a Salesforce deal, it's $4.65. If it's a Google Cloud deal, it's $5.32 for every dollar. If it's a Microsoft deal, it's somewhere between 5 and 9. So we're starting to understand exactly what the ecosystem opportunity is and the 5 main partners that lead a customer from the very early stages to vendor selection through the transaction, whether they take the money or not. There's a more likelihood in the future that they're not going to take the money, and then every 30 days forever. So there is no more single throat to choke. And what you just saw, all these permutations, you're going to have to build your own network, your own ecosystem of partners that can handle the endpoints and can handle Linux and can handle your relationships with the hyperscalers and can handle the data and the automation and all the things, the compliance, the continuity, the security, all the things you need to do to run an environment, whether it's a 30-person shop or a 30,000-person shop. is going to take, a group of friends to be able to come in and handle that layers of the stack.
Let me ask you this then. So does do the cloud offerings, whether Amazon or IBM or whoever it may be, Microsoft that's offering cloud solutions, it sounds like that doesn't automatically solve the problem either, or does it?
Well, it consolidates a little bit of the complexity. We'll talk about marketplaces in a minute. But Microsoft, by the way, has grown at 51, 50, 50, 48, and 47% in all the quarters inside the pandemic with Azure. Google Cloud is growing at 46, year on year, quarter after quarter. AWS, the head of AWS, just got a nice promotion to take over for Jeff Bezos as he heads to space. So these companies are growing gangbuster inside a pandemic. And they're becoming part of the new distribution of bits versus atoms. And what you're going to see shortly is these companies' marketplaces aren't just about selling their own software and selling software on top of that. 6 on average get sold on top of every platform, but they're bringing in services partners as we speak. So instead of Google charging you $1 for their product, $1 for the 6 other things you're going to buy to secure it and make it compliant and other things, automate it, they're going to start charging you the whole $5.32 on enterprise credits. So they're going to be the front end of paying Accenture, the MSP, the marketing consultant, the ISVs. I mean, all the different 16 layers of people that are involved in that customer. The money is going to flow through Google and the marketplace. And that's what they're actively building the tools in this front end of the decade of the ecosystem to be able to handle. We think that 17% of this industry, $3.5 trillion that businesses and governments spend, will go through marketplace by the end of this year. That's up from single digits last year. It's growing. It grew more in 3 months last year than the last 10 years combined. We think that by the end of the decade, marketplaces are going to handle about 1/3 of this industry. And so this industry, by the way, is also doubling. It's 5% of GDP. It's going to 10% by the end of the decade. So we're talking about 30% of $7 trillion. These are big numbers. That's movement of money away from resale. Today, 64% of this industry, the $3.5 trillion, goes through resellers, goes through MSPs, goes through integrators, goes through, in a lot of cases, distribution. So where that's changing is that almost falls in half. So for every $2 today, it drops to $1 by the end of the decade. And those dollars start to shift to marketplace. And then the other third is a direct play.
If you'll excuse me, I'm going to back up one bullet point in your document. Does this now speak to the trifurcated channel model, moving money away from distribution? Is that what you meant at that point? Or is that, you referenced the traditional gold, silver, bronze reseller model. Maybe you could give us a little more on that particular point and whether it relates to what you've just been discussing.
Yeah, so it's actually two different things. One is this big trend that the movement of money changes. The way customers go and acquire hardware, software, and services changes fundamentally. Today, 64% of that is through some sort of resale channel supported by distribution. By the end of the decade, it'll be 1/3, 1/3, 1/3. 1/3 through resale, down from 64 to 33. 1/3 through marketplace, up from almost 0. And 1/3 through direct, which will stay kind of flat. That is a changing of the guard. That's a changing of the way money flows. And then that changes everything else. When 64% of this industry today goes through others indirectly, there are gross to nets. And you know this from your past that, I sell at this price, into distribution, here's my list price, and everything in between is recorded financially as margin, front-end margin and back-end margin, of which I can swizzle to go and fund partners and education and training and co-marketing and enablement, all the things. So all that starts to change pretty significantly. That, we're talking, again, $1 trillion of movement away from funding partners in the same way and distributors. So that funding is going to start to move into marketplaces. Some of it's going to move into direct to consumer, product-led growth models, usage-based, value-based models, subscription and consumption models. But programmatically, my point there was, as companies start to recognize this, when I said that Cisco and HP and Dell and IBM are taking hundreds of billions of dollars into subscription models, they're looking at their channels and they're announcing different channel programs that are funded differently. You'll see build, sell, and service models, a trifurcation that says, I need to build an influence channel. In those 28 digital moments, I need those people to be strong channel partners that gets the customer to the dance with Cisco. That's just as important as transacting, but when Cisco is fully subscription, that actual transaction is only the first 30 days with the customer. It's not $1 million RFP. It's not a big procurement-led thing. It's on a departmental credit card. And this land and expand strategy, which Cisco is moving into, now shifts to the right. If that product doesn't get adopted, we're going to lose that customer. It's like Netflix. You sign up for Netflix. If you don't watch it for a couple of months, you cancel it. So in a subscription model, Cisco is going to get measured like Netflix. How many subscribers? What's your churn rate? Kind of all SaaS-like measurements. So right. If I don't get adopted, if I don't get deeper integrated and sticky, if I don't become like the SAP that you just can't rip out no matter what in a company, I may threaten my long-term value, lifetime value of the customer, which I'm measured on. Third, every 30 days now, I got a big Cisco portfolio. I need partners out there selling Meraki and Umbrella and all the other acquisitions they're making every other day. I need this portfolio to be sold. I need our future innovation to be sold. I need this whole enrichment channel. So if I'm Cisco now, I'm looking at distribution in the middle, kind of going, yeah, the transaction is really important, but I think it's about 1/3 as important as before. Because if I don't get customers to the dance in this early digital journey, which distribution isn't helping me in those 28 points because they're hidden right now. So I have no way of funding distribution in these early points yet because they're hidden. So I need distribution to change their agencies and to change the way they can help me get customers to the dance. In the way that the initial transaction happens, distribution was a big chunk, and then that's going to drop every year for the next decade. So, we need to sign up that first 30 days, pretty critical in getting a customer, but not as critical when you're selling the one-time big solution as opposed to a land and expand pilot. And then after that point, I need to shift about 1/3 of my money programmatically. These are the education and training. These are the enablement things. These are the co-selling and co-marketing. These are the pure incentives and motivation and loyalty stuff. The 100 things I need to do with partners. I need to shift 1/3 of that money after the point of transaction to make sure I have 3 really strong sets of partners, and only one set are transactional partners. Everything else is non-transactional. So I need to fund it differently.
So their mindset has to be, we're going to look at the continuity of the subscription or the consumption, as opposed to that initial transaction being the whole enchilada. And so ultimately, the old mindset where distributors are holding inventory or are doing things a very traditional way, and their added value was transmitted to the channel in a different way. It changes the financial equation in terms of how the manufacturer sees the distributor and how much funds they're going to allocate to them based on a completely new model.
Yeah, so let's break it down as the P&L for the distributor. There is a very important part of their business that doesn't go away, which is distributing atoms. You need to take laptops from China, land them, distribute them, into centers close to the customer. That's a big problem. I mean, during COVID, we emptied that supply chain and we're still struggling to fill it. And, there's chip shortages and everything else. There's a hugely important piece here, but they have new competitors here. Like Ingram is a little bit less worried, I think, about TD SYNNEX than they are about Amazon and DHL and FedEx and USPS and UPS. there's a whole set of supply chain expertise, regardless if you're distributing a server, an air conditioner, a refrigerator, something that weighs a ton. It takes up a certain amount of cargo space. It takes a certain amount. And if Amazon can get that to the customer with 1 day prime, regardless of the size, the weight, the scale, and cost, that's a different model. So Amazon, is obviously buying airplanes and buying up electric vehicles at the moment. They're the new competition for moving atoms. So now distributors aren't locked into their own little industries and HVACs over there and ITs over here and telcos over here. They're competing against experts in 3PL logistics. So that's one. Two, capital and credit facilities. When you're a small MSP in Kansas and you've got $1 million deal that you're working on, you need the financing because that customer, who you think are going to be net 30, become net 60 and net 90. And you're, leveraging your house and your mortgage up against winning this deal. The distributor plays an incredibly important role of fronting the $1 million for you and letting you hang on to that net 60, net 90 and stay afloat until you can get your margin and until that flushes. But guess what I just mentioned? 76% of companies are going into this subscription consumption model. The first 30 days with the customer doesn't need to be financed. It runs on a credit card. So the $1 million HPE server is GreenLake is now $9,000. And if a customer can't afford that first $9,000 30-day amount, HP is going to finance that internally, and the market's going to allow them to take on that risk. It's not a lease. It's not HP Financial doing it. It's part of their core business now, based on churn rates, based on lifetime value customer, and based on the market, allowing the manufacturer in this case to take on the risk, like SaaS companies do, like others do in other markets. The capital and credit facilities completely get eliminated here. And who's going to be helping HPE and other companies with this are probably big banks. And there's a new set of competition. So you're competing with Amazon over here. Now you're competing with the big Lloyds of London and Bank of America here on how money flows, in these subscription models. And then the final piece, the only piece that we really have to talk about now is marketing. So Tech Data, before they were taking private, we got to see their last financials publicly. About 80% of their profit was marketing agency dollars. So at Lenovo, when I would cut them $1 million check every quarter to put my logo on a page and run a webinar, 99% of that was profit. And it was a little bit of taxation. It was a little bit of pay to play. All the big distributors were all $1 billion players with us. And you built that into your gross to nets. You had to sign that check or you were at risk that they were going to start pushing HP or Dell, because Dell would write the check and you wouldn't. And you just played that game, and we played it for 40 years.
Understood. Very clear.
But that game is changing very quickly with the program dollars being spread out, these customers understanding these new buying journeys, understanding the elongation of the buying journey. All this changes and says, what if I didn't write that $1 million check? What if I just paid distributors, the 3% margin to do what they do? Well, then you have entire distribution industry globally, a $1 trillion industry at break even. If they're not generating marketing dollars, like they've convinced people that there's 75,000 bars that hang on every word they say. And it's just not true. There are so many other ways, it's over my shoulder, of ways to get to those bars. They're in 143 social groups. They listen to 100 podcasts. They read 59 magazines. There's actually 14 spheres of influence. I could give you 14 of those lists that capture the entire industry, millions of partners. And you can get to their hearts and their minds directly into these watering holes without having to go through distribution to get into those watering holes.
Maybe it's a good time to segue. I'd like to, whatever you care to share, how are those communities being hosted? And I'm involved, as everyone seems to be, more and more with LinkedIn communities, but I suspect that there's a much wider variety of communities out there in the type of environment you're talking about. So Tell us about some of the proprietary communities supporting that transmission of knowledge and information.
Yeah, so I just wrote a big report. We can probably include the link in this podcast. But I looked at all of the watering holes. So on the social side of things, there's 81 LinkedIn groups, but they're actually dying on the vine. If you look at engagement, if you look at how many people are in those 81, and it's become almost like a vendor spam, one-sided spam session in many of these groups. So a lot of the activity at the partner level, by the way, has moved over to Facebook. So I looked at 25 to 30 Facebook groups that have all kinds of engagement. And we're talking thousands of messages a day and pretty vibrant communities. But breaking free of LinkedIn and Facebook, some of the biggest activity is, for example, on Reddit. There's 110,000 MSPs that are in subreddits, having all kinds of conversations, free of vendors, free of others, and it's anonymous, so you can use all the expletives you want as you're in these groups. Other places like Clubhouse, they're actively. I actually run a Clubhouse room with 4,000 people in it, having active channel technology conversations. It's another avenue.
When is that, by the way? I'm sure our listeners would like to know.
So Clubhouse got a lot of buzz in the last year. It's an audio-only format. And think of a community of people that log on in real time.
So I know what it is. I'm asking you when is your specific moment on Clubhouse? This group that you're hosting.
So the group itself is called Tech Alliances. It's run by Bader Hamden, and I think he runs every Friday or something like that. But it's got over 4,000 people signed up. But I'm just giving you examples of other platforms now that are picking up the watering hole conversations for particular types of conversations. Discord, which was a gaming platform for conversations, is just as vibrant as Reddit at this point around channel conversations. You have Slack. If you talk about channel technology, there's 7 Slack rooms right now. Things like partnershipleaders.com, Cloud Software Association, that are channel leaders talking about better serving their ecosystems. So we're not in LinkedIn anymore. There's 143 different watering holes in this industry. My point is you don't have to go through Ingram, or you don't have to go through D&H. You don't have to go through a VAD in Europe to get access to these rooms. They're peer groups, they're user groups, they're grassroots level communities. And again, you don't have to use the distribution agency, which don't have really access to these conversations anyway, to get access. So it's not a closed room like it was in the 80s or 90s, where the only way to get to 75,000 VARs as a part of a distributor was through their direct podcasts and webinars and brochures and marketing campaigns. These 75,000, and by the way, the millions around the world, are actually open to every vendor to go and directly, play a community role without distribution's help.
And how has that affected the amount of human resource or the number of team members that any of these suppliers have to throw at that? I mean, does it go from, a tight-knit group of a few people up to hundreds of people engaging with these communities?
It's actually shockingly few people. So I worked at a company called Autotask 11 years ago. I left with the founder of Autotask to run another company called Channelize. But keep in mind that Autotask was a community-only company. There was, not very many salespeople. There was not very many marketing people. The effort of go-to-market was all around community. Who did they compete with? ConnectWise. ConnectWise was a community-based company. IT Nation and all the things that ran at ConnectWise. So here's an industry, the MSP, the managed services industry, grew as a community model, not as a selling or marketing model. And so Autotask combined with Datto, and now today is a public company worth $4.2 billion. When I did the list of 100 most important people globally in the MSP channel, the 75,000 MSPs, Rob Ray from Datto was the #1 person of influence in the world. So to get to Rob, to work with Rob, to work within the DattoCon community or ConnectWise or Kaseya or SolarWinds, if you truly want to recruit and drive an MSP strategy, you're not limited to go through distribution to do that. You're actually better off engaging in the 31 communities that drive MSPs directly. And you can do that with one person. A company like Cisco actually hired my wife to do that. You can literally do the entire MSP market and the as a service market with one community manager.
Fascinating. Fascinating. Now, one of the types of organizations you mentioned as well in your report is, let me see if I can grab it. Both Meraki and AppDirect. And does the advent, are those sort of cross product with marketplaces or facilitating rapid growth of marketplaces without like if I'm a reseller, can I jump into this very rapidly without doing any of the traditional things I would normally do? So basically it's like flipping on a business instantly. Is that how that's working?
Yeah, so let me walk through kind of marketplace at a high level and break it into, kind of easy components. So at the top, I mentioned that 17% of our industry would go through marketplace. That's the way money changes hands, perhaps by the end of this year. By the end of the decade, it's probably a third of our industry. So it is big. It's trillions of dollars. It's broken into really three types of marketplaces. I call it a hyper marketplace. In the B2B space, there's going to be a lot of money spent through Amazon and Amazon for Business. There'll be a lot of money spent through Alibaba for Business, etc. In the middle, there are super marketplaces. So we're not going to have thousands upon thousands upon thousands of big marketplaces. We're going to have 20. We already know who 15 of them are, and we have a guess who the next 5 are. But AWS, Microsoft, and Google are already winners in the super space. On the SaaS side, you've got Salesforce, ServiceNow, Workday, Marketo, NetSuite, already emerging as winners, HubSpot as really impressive marketplaces. On the more legacy side, you've got IBM, SAP, Oracle, who will be successful in their marketplaces because they're $100 billion companies. You've got Dell, who's late to the game as being the e-commerce golden child of the 90s, who just missed this entire marketplace opportunity. And they're late to the game, but I bet that they're going to become, one of the players. And so we're building out this list of 20 who I think will take 80% of the marketplace spend. So that's really important. That's not only hardware, software, and services. It's that $5.32 multiple at Google. More and more is going to go that way. There's a whole bunch of reasons why, but the most important is enterprise credits. They've stopped trying to do permutations as distributors do at a SKU level. They've just given up and said, Bank of America, just buy $10 million in credits with Google this year. You can take them down any which way you want. If you can find more stuff to buy, like hardware and other stuff, go at it. The more you can consume, the bigger discounts you get. There is no more rogue IT. The CFO loves it. Everybody's on this chase to spend more with Google. It's like, you don't want to be on airlines, like 9 different airlines collecting points, because you're going to be a silver member on 9 airlines. You want to go with one and become that platinum gold level, service. So the same thing goes with enterprise credits. That's in the middle. On the third side of the marketplace, which is 20% of the opportunity, is what I'll call niche marketplaces. When I went back and talked about 35 million customer conversations, there is literally 35 million marketplaces that somebody could build today. If you want to build a marketplace for mid-sized clinics in upstate New York in front of a marketing buyer, you can go do it. Are you going to be successful? Absolutely not. But if you start to take back a step on those 5 vectors and say, what about mid-sized clinics nationwide? It's highly curated. So it's HIPAA compliant, high-tech compliant. It's curated that everything works together. So I don't have to go into the vast Microsoft marketplace where everybody and their dog is over there. As a mid-sized clinic, I can walk in and see, a nicely, tightly curated list of things that are going to work together, including service partners that can do it. And it's going to be a really interesting place to buy. Right now, there are thousands of marketplaces that are sustainable and repeatable that are working. I think there will be 10,000 plus, over the course of this decade. There are only a few companies behind all of those. These 10,000 marketplaces are not going to be homegrown, wireframes, e-commerce, all the, stuff to make it work. They're going to go to companies like AppDirect. They're going to go to Miracle in Europe. They're going to go to Ingram Cloud Blue, but they're going to go to companies like this that actually bring you in a catalog of thousands of vendor products. So now I can start up my mid-sized clinic marketplace, but I already have the Microsoft 365. I already have, Salesforce. I already have like the basic level technology that I need. I don't have to go build relationships with all those companies. It comes in as my catalog. And now I can curate that and I can add on the very specific things for my buyer and my industry and my geography. And now I have a marketplace that I can build in days and start to tax and monetize, a platform level of leadership to a certain part of the market. So and those are the companies we just mentioned.
It sounds like concurrently you have the advent of, let's call them horizontal marketplaces and very verticalized marketplaces that are, really broad and really narrow marketplaces emerging all at the same time.
Absolutely. And when we talk vertical or horizontal, I actually like to talk in vectors because it's a bit more complicated, but there's not, two planes here. We're playing a little bit of 3D chess. I can go and build a marketplace today for a buyer, a successful one. I can build a marketing buyer marketplace, which I said, many marketing professionals spend more on technology now than the CIO. So yeah, I've got a really nice audience there of people with a lot of money. And that 8,000 logo MarTech stack that some of us have seen at Chief MarTech, I could take those 8,000 companies, serve that up in a marketplace just to a buyer. Doesn't matter what industry they're in, what geography they're in, I'm just serving a buyer. That's one kind of marketplace. Another kind of marketplace is I can serve the industry. So I'm going to be the FinTech, the MarTech. I'm going to be the InsurTech. I'm going to be the GovTech. I'm going to be the PharmaTech. I'm going to be the Cannabis Tech. I'm going to be a sub-industry, 297 industry-based marketplaces. Who cares who the buyer is? It's actually more about what they need to buy. So if I'm cannabis, I'm selling lamps and fertilizer and all kinds of things, which is curated on top of the cannabis tech, on top of base technology like Microsoft and others. So now I'm the person who's the platform for the entire cannabis industry globally. The third is geographic. I can go set up a Canadian marketplace that serves Canadian legislation, compliance, regulatory, blah, 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 blah. Different privacy standards up there. So I can curate things for Canadians. That's geography. Number 4, I can build an SMB marketplace. You see several of them today. Vendasta up in Canada just raised $129 million to compete with AppDirect in the SMB space. So I can do it I can build a mid-market or I can build a Fortune 500 type marketplace that gets rid of the riffraff and only offers up enterprise class technology. So instead of 4,300 security companies, I might choose the 200 of them that have proven Fortune 500 level secure, zero trust. And then finally is the technology. There's 250 categories. I could go build a security marketplace. I could go build a data continuity marketplace. So those are 5. That's at the top end. I don't think those will be as successful as going into 2 vectors. Going into a marketing buyer in a certain industry will be a tight enough marketplace that you'll get visibility. You'll be able to curate the right level of stuff and make it an ongoing concern. You're not going to be a billionaire, but the way to monetize that, whether you're a media company, an association, you're a vendor, a distributor, your chance to go and carve off that slice of the market using AppDirect or Miracle or something else is there for the taking.
In reflecting on this conversation, and recently I had the opportunity to have a conversation with Jeffrey Moore, who is, I would call him probably the king of disruptive innovation marketing. It sounds to me, correct me if I'm wrong, it sounds to me like marketplaces are probably the number one disruptive innovation, or do you feel like something's even more potent than that?
Well, from a distributor perspective, it might be the number one because it changes the way dollars change hands, and that has a material impact. Not to say subscription and consumption models don't have a really large, when 60 to 80% of your revenue is to companies that have announced a subscription model, that's pretty material. But here, the future buyer, think about the last time you bought a car, the 28 moments that you went through on YouTube, in magazines. You had to get 365 cars down to the one that you were actually going to walk onto the dealership with. You went and got the invoice price. You went and did all the configurations. You talked to your neighbor. You went into Facebook groups. Like, you did a lot of stuff in those 28 moments. This digital journey is everything, is the biggest disruptor, because no one at this point, at least 68% of people today, don't want to finish that digital journey with a physical transaction. When you walk into that dealership and they sit you down for 8 hours to buy the car, and they're trying to get you a deal from the manager, you're sitting there thinking, like, this is about the worst customer experience I've ever heard. I already know what the invoice price is. I already know within $100 what we're going to sign this deal at, because I've done my work. I know more about the car than you do, and I probably know more about the deal than you do. The incentives, the back-end rebates, I know a lot going in. So I would rather pay you $100 more for you to deliver the car on my driveway and hand me the keys, because I'm just done with spending 8 hours in this old-fashioned physical model. Now let's move that into software or into other hardware and things. This is what customers are thinking. I know more than the salesperson. So now 51% of the cases, I'm not going to talk to a salesperson because I know more than they do. I'm not going to fill out a marketing form with the correct information. I now have Apple and Google not tracking me by cookies, and I can truly be anonymous during those 28 moments. This is all pretty cool. Well, why do I want to go physical? Why Larry in the white van is the place that I want to buy the product after doing all that work and becoming smarter than Larry in this very particular case? I don't. So people are going to, this decade, are going to finish digital journeys with a digital transaction. And at the end of the decade, you'll probably be spending digital money. Like I talked about enterprise credits, but it could be cryptocurrency. The point is this entire journey, and then you start the every 30 days forever, that's digital too. So my entire life on every product I'm going to buy, whether business or consumer, is going to be on this elongated digital journey. It's what millennials want. It's what Generation Z wants. And more than not, baby boomers and Generation X are wanting this too. So that's why a third of this industry is going digital. And that's why marketplaces are the actual platform for going digital and collecting all those dots, doing the orchestration, doing all this work of getting those 5 people in the room, getting the money spent and getting the work done properly. So everyone is delighted.
I think you're doing a great job summing up as we're near our hour here, Jay. But is there any last salient point that you want to bring out from your document?
Well, the last point is the recommendation. If distributors, are listening, what do you take from this? Okay, I get it. There's all these things going on. We've survived before. We've faced headwinds all our lives. We find our way through. And no one's calling for the end of distribution. So the fact is what kind of company are you going to be at the end of the decade? And here's the answer. You need to become a platform for distribution. Much like Salesforce is a platform for sales technology, HubSpot is a platform for marketing technology. This ecosystem orchestration at scale, this ability to connect dots from hardware and software and services, the ability to solve customers' problems and be involved in every one of those moments across this journey is where distributors need to be. It's distributing atoms and bits in the most successful way possible. You've got distribution of bits today, companies like Pax8 and SureWeb. They're taking a chunk out of distribution because they don't have any legacy debt. They don't distribute anything physical. So they can actually come at it with a new clean sheet on distribution. You've got master agents from the telco world becoming technology services distributors, taking a chunk out of that in IT. So there's a lot of disruption happening, but those who become the platform of distribution in your particular audience are going to be winners, and maybe valued not at 10 cents to the dollar, but start to look at some of those other side valuations that other platforms. Go look at the valuation of HubSpot or a Salesforce on the stock market today. That's a platform level valuation. The second and final thing I'll say is distributors starting today have to come out of hiding. It's getting very long now in the tooth, 40 years of hiding behind partners. They're scared of showing up in front of the customers that the partners are going to get mad. It's actually the opposite. In an ecosystem, in this new partner journey, these 28 moments, customers are so smart that they want to buy value. And they're okay spreading that across today, 7 different companies, plus 5 different partners wrapped around it. Distribution can step out and show the value they provide. And I mean, it's dozens of value areas that they should be talking to customers with their partners. Because in the end, the distributor is not going to show up on site and do the integration, implementation, the security. They're not going to do that. They might back end a little bit of it. But partners would be benefit if these big fortune-sized companies would start spending money to rise up this idea of partnerships and how they add value. And if they can come out of hiding, become a brand that my kids would be able to recognize, and all boats rise. And they need to start, being less scared about, threatening one of their partners that they're going to take the business direct, because they're not. They're just a really important set of building blocks in the broader solution. And they have many, many more resources than, smaller partners do to come in and compete for all of these moments.
So in reality, what the end customer needs is a complete solution. Not they don't really want to be at the minimum viable solution area. They want a real robust complete solution, and the only way to deliver that complete solution is by a group of suppliers working together, and that's an opportunity for the distribution cycle. That's a new opportunity if they will in fact step up and leverage it.
So if they can orchestrate those 5 partners on average, if they can orchestrate the 7 layers of the solution, and they can deliver that through a digital platform, which, many of them invested in these digital tools, to the customer, it's like, I'm not going to start my journey with AWS. Even though I'm going to buy AWS, I'm going to buy AWS through a distributor who also has the 6 layers above it, who also has the 5 partners. The distributor is the platform here that makes more sense of spending enterprise credits with than AWS. That's the model. And that's not going to be for every customer. But again, we're talking about $7 trillion by the end of the decade. So there's a lot of money to go around here. And so the idea is you are not going to be successful being that orchestrator, to be that platform, if you never show up in those 28 early moments. And if the customer walks in without any idea of the value that distribution has, when they actually go to spend money and click on the boxes on the marketplace of what they're buying, they're not going to click on the distribution box because they don't get it. So that's the end goal here, is come out of hiding, become that platform, and go compete against these big supermarketplaces. Become one of these top 20 supermarketplaces that actually does a better job of solving the customer's issue and driving better customer experience over time than going to buy from a single vendor marketplace.
I think we've had a wonderful conversation, Jay. I really appreciate your time. Is there anything, everyone knows you already, but is there anything you'd like to share about how to get in touch with you to further leverage the Forrester research?
Absolutely. You can find me anywhere. If you want to send me a Facebook message or a LinkedIn message or a direct tweet, my email is jmcbain@forrester.com. Happy to point you to kind of these numbers that I'm talking about and some of the research that we've talked about. I do write a professional blog on Forrester. I write a personal blog, kind of musing about the industry and stuff like that. But when I talk about 143 social groups, I've got them all listed, the owners of the groups and how it all works and things like that. So anything of interest, happy to point you to what the link is, or if I can add 2 cents in your particular, part of the world and in your 35 million different permutations.
Sounds great. And, in my case, it sounds like lots of people have challenging decisions that they're wrestling with and how to take their organization. And, I'm happy to help with that as well. So thank you, and really appreciate your time. Have a great day.
Take care.